Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here with us. Got a great show planned for you today. I'm going to start off talking about, and I'm so disappointed to see people get burned on this, but watch out for the Chinese stock scam. Everybody wants to make big money on stocks. This is not a good thing. We'll address that. Also, too, is the current 401k system out of date? We'll talk about that, some changes that you need to be aware of. And also, too, this is very important, the unknown risk of the S&P 500. We found another risk in the S&P 500 that you need to know about. Stay tuned for that.
Yeah, and then companies we're going to take a closer look at today includes, I think it's Pfizer. I'm not sure, though. It's not Pfizer, the pharmaceutical company. It's Fiserv, the financial service company.
It's not Pfizer?
Maybe it's Fiserv. It's
Fiserv.
Fiserv.
Doesn't Google have a thing and put it in, it'll kind of enunciate for you, maybe?
Maybe. I don't think it's always right,
You can
though,
do that.
so,
We
yeah.
can do it.
Other companies, though, don't want to get hung up on the name of this one company. We're going to look at Pinterest and then Duke Energy and General Mills. So, again, got a full show for you here today, and let's jump into it.
All right. Well, let's talk about the watch out for the Chinese stock scam, because it occurs in very small Chinese stocks that are vulnerable to manipulation. No surprise here. But for some reason, I don't get this. Some U.S. investors see these and they think they're going to hit it big. Like, wow, this is great. The company, or the hucksters as we'll call them, they trick people who should know better. And even smart business people fall for this. And I was shocked to read even a university professor lost $80,000 in a scam. I thought they're pretty conservative and they're smart, but these guys are good.
Yeah, I mean, I think they're good, and also, too, people want to believe that it's going to work out. And they're going to, again, make that quick buck. And, you know, as you're kind of talking about that unknown risk in the S&P 500, we'll get to that. But, you know, we've talked a lot about valuation concerns. One other thing is, they're talking about on CNBC this past week, you know, there's a lot of froth kind of starting to percolate once again. Mm-hmm. You kind of have these speculative investments doing very well. I'm going to throw out, obviously, cryptocurrencies have been doing very well once again. Kind of have these SPACs making a little bit of a comeback.
SPACs are coming back?
That's what David Faber said on CNBC.
Oh, wow.
He's like,
That's
kind of interesting.
Yeah.
The last thing I was going to say, you can kind of tell when things are getting a little frothy. Scams. When people feel good, they're starting to chase returns. I think scams are another key indicator that things are kind of getting out of control. And I thought I'd point that out because, again, we're seeing more and more scams coming out. And the reason I think that's so true is because when people have money, well, they feel like they can gamble a little bit more.
Yeah, and they feel more confident. Oh, things are going pretty well, so I'm pretty smart. It's been a long time since I lost money, so I'll do this. And they're advertised. I mean, you're going to find these on social media or messages on WhatsApp, and they contain investment advice, and it looks very convincing with the allure of big, quick returns. That's what everybody wants, but it's a fantasy. They trick investors into thinking that this company that they're talking about, that they're promoting, is on the verge of something very big, and they show that, hey, you can't miss out. They already got some short-term gains. If you miss this, you'll miss the bigger gains. We're already doing well. And the problem is, it's engineered by the scammers who do this through manipulative trading. That's how they get the short-term gain. And then you want to jump in like, I don't miss the big gain. So
yeah, and the big problem here is you look at the regulators. I mean, they try and do their best, but typically can't get access to information in China to go after these people. Yeah. And then also China, I mean, they're not as, I'm going to say, stringent, obviously, here as the U.S. regulators, where we're very keen on these, I'm going to call it pump and dump schemes. You can't just bid up these penny stocks and then, you know, kind of tell people, hey, go buy this penny stock that's only like a $5 million market cap. You bid it up, you then sell it. That's illegal. You can't do that. I guarantee you China does not have those rules. So there's kind of this, I'm going to say, loophole for these scammers where it's hard to kind of catch them because, again, the limitations of U.S. regulators. And kind of talking to that point, I mean, these hucksters, these scammers, they're coming from Malaysia, Taiwan, and other places around the world. So very hard to track down. And then this blew me away. But I mean, some have even been so bold that for some investors who lost money, they come back with a second better offer to make up losses on the first investment. And, you know, what's the saying? fool me once, shame on you. Fool me twice, shame on me.
Right.
It's like, no, please don't do that, people.
And they wouldn't, and people have done it obviously because they wouldn't write about it if it didn't happen. And I'm sitting back thinking, I bet China wants nothing to do with this because they probably enjoy with the tariff situation. Yeah, good. We're glad American people are losing money on these scams. They probably want it. Maybe they even endorse them. I don't know.
I mean, hey, we did get some news though. There was some positive developments in the U.S.-China trade relations.
Yeah.
So
That was yesterday, on
positives,
Friday.
yeah. Mhm.
Yeah. Do we talk about that today, or we're just gonna?
I'm just going to kind of mention, there wasn't really many details on it, so we'll just kind of throw it out there. I was just going to say, maybe China doesn't hate us as much.
Oh, yeah, because I did say there was some positive news on that, but negative on Canadian side. Talks are done for Canadian trade right now.
They're going to impose a digital service tax like the EU does, and Trump's like, nope, no deal. We're done talking. So.
And I knew there's going to be some good stuff, some bad stuff comes out. But back to the Chinese stock scams here. I like to recommend some way to get around this. There really is. When you see these small Chinese stocks, especially if you see them advertised on social media, WhatsApp, whatever it is, remember the old saying, if it sounds too good to be true, it probably is. And just stay away from these. I mean, if you got money to throw away, and I know, some people are like, oh, I bet $200 on a penny stock. I guess that's fine. But, some people are spending thousands. Again, that professor lost $80,000 of an investment he did. That's just, don't do that.
Yeah, that's just silly. And I don't like to gamble in the stock market, especially not the Chinese stock market, because that's all it really is at the end of the day is gambling. And that's not what I would want to do with my investments. Because again, you say $200. What's the point of that? There is no point of doing something like that. You could make, doubling of your money and make $200 on your investment. That's not going to make a big difference long term.
And it might feel good, but when you lose, it never feels. And I do remember that the negative side, the loss, is far greater on your emotions than the win side. Yeah. You feel much worse about losing money than you do about making money.
Yeah.
So stay away from all this small stuff. Let's talk about the current 401k system. Now, asking, is it out of date? Because this was established, the current 401k system was established, I can't believe this, 42 years ago in 1978, when the use of normal pension plans was in place, and those were the defined benefits. The company would do everything for you. And when people still worked for a single employer for most of their career.
Yeah, and it is obviously kind of a little bit different now, but we'll kind of get into that. The interesting thing is you go back to 1978. I mean, this was a huge change for, employees and employers, and it was really beneficial in my mind for both parties. Reason it was beneficial for employees, it gave you more control of your retirement. Obviously, you pass away, you have that pension. Many times it ceases to exist, no longer have that income. Or now the 401k can be an estate planning tool where you can leave it to your heirs. So positive side there for employees. But for employers, it reduced the long-term financial risk for many companies with underfunded pension plans that caused multiple problems for companies during the 2008 financial crisis. So, I mean, I think this was a win-win, and I personally think the 401k, as I'm going to say an employee, so much better than the defined benefit plan.
And I think the problem with defined benefit plans, what happens when the market goes down, your plan goes down, and all of a sudden you got to make larger contributions when your company's having a difficult time because business is down. So that's why they're very difficult. But times have changed, and the thing is now employees, they might experience over a 40-year plus career, different jobs, could include such things as side gigs, the launch of a business or two, potentially a job change that could take place as many as 12 times over that 40-plus year career. And that is really difficult because we've seen the negative side of that, what people do, but you've got to be prepared for that and understand how to use the 401k system so you do have a good retirement when you get to retirement.
Yeah, I mean, kind of talking to that point about people changing jobs and why it can be so dangerous, I'm going to say first the positive side. Again, it gives you control. I mean, you can take that money with you essentially.
Yep.
But the problem is you can take that money with you or take it out of the plan. And we just see this far too often. Mm-hmm. It drives me crazy. When people change jobs, they then decide to take the money. Instead of moving it into an IRA or into the next 401k, they're like, it's fine. Just give it to me.
It's only $10,000, only $20,000.
Yeah. And then you lose many times half of that to penalties and taxes. And it can just be, I think, devastating. Again, you do that not once, twice, 3 times, but you do it 5 times over your career. I mean, let's say you had $10,000 each time. That's a $5,000 loss. That's a $25,000 differential to you long term, not factoring in the compounding of those investments. I mean, it is just devastating. And we plead with people when they're at 401ks and they're leaving and they're like, I'm going to take it. I try and tell them multiple times, are you sure? We're going to lose this amount of money. Are you sure? And they still do it. And it just drives me crazy.
And again, they hit with the taxes, they hit with the penalty, and they still don't care. And in my opinion, there's not one good reason why you should be taking your retirement money early, as when you'll pay for it many times over when you reach your retirement. That's what people don't realize. Like, yeah, what's a big deal? It's $10,000, $20,000. But it has been estimated that frequent job changes over a career can cost as much as $300,000 in retirement savings. That's the compounding you're talking about. You take it out now, okay, big deal, it's $20,000. But if you've got 40 years to go and you've got compounding at, every 8 to 10 years, I mean, that $20,000 could be worth well over probably $150, adding to what you did. And and again, we do plead with people pretty much like, don't do it. It's going to pay taxes. Oh, it's, I need it. I want to pay off my car loan or something. It's just something that is not worthwhile doing.
And I don't know if that factors in as well, but generally if you leave an employer, there's something called a vesting schedule. So if you got profit sharing or you got a match in your 401k plan, you're only there for 2 years. Well, you wouldn't actually get that full match or that full profit sharing that the employer made in many cases, because generally there's about a 6-year vesting schedule. You have to be there for 6 years to get that full amount that the employer puts in.
Right.
The employee, whatever you put in, that is yours, 100% that is yours. But the employer, you leave early, you don't get that full amount. So that can also actually be, I'm going to say, a hidden cost to you as well. We're like, I got this job offer and they're offering me a slightly higher pay, but you might lose some money if you leave early. So, that is always something to kind of consider for people that you may not be thinking about. But one other thing, too, that we look at in terms of the savings rate, I think this is positive, and I'm going to say negative. I'm not, I think, as big on it as you are, but the auto-enrollment. Yeah. And what this is it's a default for employees starting a new job that they will essentially just be automatically enrolled in that 401k plan with an automatic deferral rate. And, the reason I'm always kind of like, well, it's kind of good, kind of not good. If you're automatically enrolled into it, what is the likelihood that you're actually going to go in there and go in and look at the investments and actually allocate it properly? Most of the time, people that do the auto enrollment, you're going to be auto enrolled into a target date fund, which again, we're not huge on. It's not the worst thing, but I don't think it's the best thing. It's like, gosh, we just need to educate people to take advantage of this 401k plan. I want you to want to help yourself, essentially, at the end of the day. But unfortunately, that might not always be the case.
And I'll take what we can get, and that's why I like the auto enrollment, because it gets done for people because they say, well, sign up here, like, oh, okay, I'll do it later. Later never comes. So that's why I like the auto enrollment. And you're correct that sometimes it's not the best investment, but maybe down the road, people look at like, oh, I got a few $1,000s. Maybe I should look into this a little bit more because they've been put into it. And actually, I believe that now increases that automatic enrollment as time goes on. So I'd rather see that than nothing at all, and people procrastinate.
And the downside is, I know you're kind of going to get to this with your second point, but it's hard on the employer.
Yeah.
If you don't do it, it's an administrative thing that the employer has to do. Well, you get penalized if you don't do it properly. So it is that's one reason I'm like, I don't like this, because the employer, again, is having to bear some of the burden here. And if you miss a couple employees auto enrollment, or you miss that increase on the employee that next year, that's on you. You have to pay a penalty for it now.
Well, and the thing that I don't like is that what they want to do now is they want to add that when you go to that new employer, your 401k actually rolls over that new employer. And also, too, that new employer has to match the same thing you had before, same contribution, same match. That, I think, is wrong. So I'm 50-50 on it. I like the automatic enrollment. But, again, I don't like the fact that people have to roll over their 401k to the new employer because you'd be getting into a crappy plan. And
the hard part is we have 6 employees.
Right.
It's very easy for us.
Do we lose one?
Maybe we have 7.
Did somebody quit?
But the thing I look at is very easy to manage that. When you have 100 employees, your chance for risking that person and actually doing that auto enrollment on 1, 2, 3 employees, it increases. Right. So it is a potential risk to the employer. And that's the big thing that I've always looked at with the auto enrollment. And then, as you said, now moving that money in, I mean, I try and say, well, I don't think we should make things complicated on the employer. They should be focused on running their business. It should be as easy as possible for them.
And I would guess, playing devil's advocate here, that if you have 100 employees, you probably have an HR person or department that can handle that for you. So I think, again, it's a terrible idea to get employers changing jobs to lock in the new 401k to roll it over. Again, we talk about the additional work for the employer. I just see problems happening with that. And I get the concept that they don't want people taking it. but it could lock you into things that are bad, and it takes a lot from the employer. And I want to address too, I mean, people say, well, gosh, Brent Wilsey said there's no reason to ever take it. Gee, there must be some reason. What I want to lay out is that it may sound very important now because maybe you got a lot of credit card debt or some hardship or whatever, but think about this. You're 65, and again, 30 years from now, longevity is probably going to be maybe age 100 because of advancement in medical and technology and everything else. You don't have enough retirement. You got to live 40 years in poverty. I think that's a lot worse. I almost cussed. I think that's a lot worse than going through that hardship now and not touching that 401k. I stand behind what I say. There is no good reason at all to take that money from your 401k, roll over, whatever, because you'll experience much harder hardship when you retire with very low or not enough retirement funds.
Yeah, it's hard to visualize retirement.
That's a problem.
Because it's so far away.
Yeah.
But again, when it hits you in the face, you're like, oh,
yeah.
I wish I would have listened.
I wish I listened to Brent Chase Wilsey. You might hear that. I could be gone in 30 years. So, anything else on the 401k? I think we hit it pretty hard.
No, I think I got a lot to say on the next topic, so I want to make sure we have time.
Oh yeah. We got the next one. I love the next one. The unknown risk of the S&P 500, and we are very conservative when we invest at Wilsey Asset Management. Many people love investing in the S&P 500 because the recent performance has been very strong, and we're talking the last few years here. We have talked in the past about the overconcentration of technology in the index, but I was shocked. I just read this past week that 71%, or roughly 351 companies in the index of the S&P 500 index, they report either non-GAAP income or non-GAAP earnings per share. And GAAP is generally accepted accounting principles. That's the standard.
Yeah, and I wanted to get into this too before I get into my next point. You talk about the overconcentration risk, and I haven't looked at these numbers in a while, so I'm like, I'm going to look at this.
Maybe a little bit better. Did you look at it? Oh, go ahead.
Yeah, the top 10 companies are now about 38% of the entire S&P 500. No, it's worse. I mean, NVIDIA now is almost 7% of the entire S&P 500. So, I mean, those top 10 companies are NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Google or Alphabet, Berkshire Hathaway, Tesla, and JP Morgan Chase. So, essentially, 8 out of the 10, I'm going to say, are high valuation technology companies, and then again 2 financial companies with Berkshire and JP Morgan Chase. So this is what we're talking about with the overconcentration risk. You cannot deny that is, I'm going to say, a problem to have almost 10 companies occupying 40% of the S&P 500. That means 490 companies, or 60% essentially of the S&P 500. That is overconcentration. That is something you have to watch out for. But back to the, again, unknown risk of this GAAP versus non-GAAP. The reason it's so dangerous for investors is because you're not comparing apples to apples. Some companies you might be looking at GAAP numbers. Other companies you might be looking at non-GAAP numbers. And I was kind of surprised by this, but 89% of those 351 companies that made adjustments, well, that caused the results to actually appear better. So I will say it's kind of weird that even 11% promoted the non-GAAP numbers if they were worse. I was kind of more surprised to think about the 11% versus the 89%. And the reason that I think more and more companies are doing this is Wall Street has really forced companies to continue to report higher and higher earnings each year, and sometimes each quarter, or else the stock, I mean, it just gets pummeled.
Yep.
And these non-GAAP numbers can be very dangerous if you don't understand what they're backing out.
And the non-GAAP numbers, they were supposed to be allowed, and again, they did allow it to explain extenuating circumstances or extraordinary circumstances like a factory fire or a sale of a division. But companies have abused this rule. They exclude items like stock-based compensation. Again, that's compensation. Amortization of intangible assets. And currency fluctuation. These just drive me crazy, these things.
Yeah, and I know Warren Buffett's saying what you're saying. He's like, there's a key word in stock-based compensation. Compensation. I mean, that is an expense to a company. So the fact that they back that out, I think it is disingenuous. And this one too, I mean, it blew me away when I saw these numbers here. But the one that just drives me crazy is restructuring charges. And sure, you go through a major restructuring that maybe lasts a year. Yeah, I mean, you can maybe kind of say, yeah, you can back that out because it's not going to give you an idea of future costs. The non-GAAP gives you a better picture of what it's going to look like when you remove those restructuring charges. But the one that you look at here is Oracle has had a restructuring charge for the past 5 years. What is this, a 15-year restructuring? I mean, at that point, that is not giving you a better picture of what I'm going to say normalized earnings look like if the restructuring charges are part of your normalized earnings.
Yeah, every
That's
year
a big concern.
It pops up. And again, Oracle, we just mentioned that. There's others that do that as well.
100%.
And it's just, you've got to understand these. And unfortunately, I don't know where the SEC is because they're have been absent on enforcing the rules. Non-GAAP earnings have just, they become the standard now. It's not like the exception. It's now the standard. And the problem for investors is with no standard, you cannot compare two company earnings. You're going to buy high-risk companies because you think they're okay because you don't understand the GAAP accounting and you don't understand, well, gee, I'm going to buy this tech company because they're earning so much higher than this food company. But the food company's doing GAAP earnings. Tech is not. You're not comparing apples to apples. You're comparing apples to grapefruits.
Yeah, and I think what they should do is they should have GAAP earnings, and then as a subline, just these were one-time expenses.
Right.
To me, that is going to be a lot easier for investors and kind of dig into the weeds of, well, okay, I mean, yeah, maybe their earnings were $5 per share, and last year they were $6 per share, but yeah, they sold a building, and that actually caused them to lose money somehow, or it caused them to gain money the previous year. You should then be able to analyze that data. But it is just so weird to me that you have so many companies that the discrepancy between GAAP and non-GAAP is so large, and how you can justify that, I'm just not sure.
Yeah, it's just something that you have to look at. And I scratch my head because I wonder, and I know many investors, they don't look at the financials like we do. Yeah. But that's why people say, oh, stock investing is so risky. It is not if you do what we do to look at the financials. And then before we buy a company, 10, 15, 20 hours, I know some people say, oh, NVIDIA's up, I better buy it. And that's the research. And that's where those investors someday do get burned. I mean, I've been doing this for 40 years. I saw it in 87. I saw it in the banking crisis in the 90s. I saw it in the tech boom and bust. I saw it in the Great Recession. When you don't do your homework, when you don't understand what you're buying, you will get burned. You're just gambling is all you're doing if you're just guessing at the company.
And, I mean, you look at this non-GAAP versus GAAP situation, the last time this was as prevalent, I'm going to say, as it is now, the tech boom and bust. And people say, oh, it's different this time. And, I mean, it just drives me crazy. It's like, it is different this time. You're right. Different companies. There's no pets.com. Yeah, that's not a company anymore. But I'm going to say it's a very similar story, and I think that is cause for concern. I think you, as an investor, should know, again, the difference between your GAAP and non-GAAP earnings for a business, because it could, as you say, burn you down the road. And as we've talked about, we are more conservative investors, but I do believe fundamental investing in the long term is going to produce better results, which is why we stick to it. And again, we miss out on some great companies, some great returns. I would have loved to buy Palantir. I would have loved to buy NVIDIA. But also, too, we don't buy the Beyond Meat. We don't buy the Rivians and the companies
and
like
the
that.
Super Micros.
Super Micros. I don't even know how that stock's doing as of late.
I think I saw it like at 40. It was up like 10% or something, but I think it was 500 or something.
Something crazy.
All this information does come from our newsletter. Again, I really encourage you to get the newsletter because you can talk about if you have any money S&P 500, you can read the one that we just talked about. Also in the newsletter, you got Republicans or Democrats. There's an ETF for you. Consumers confused on what tariffs are costing them. Do you know who has the second largest trade imbalance in the U.S.? And our car is too good for today, and fees on premier credit cards are increasing. Is it worth it? Go to the website, smartinvesting2000.com. That's smartinvesting2000.com. Free newsletter goes out every Friday by email. And again, you got to read the one on the risk of the S&P 500. So, are we going to do companies now? What are we going to do?
Yeah, let's jump into it.
Okay, which one's first here?
Pfizer.
Oh, it's right in front of me, and I'm kind of looking, where's my notes here? Okay, so Pfizer. Pfizer or Pfizer?
Pfizer.
Let's just say the symbol FI.
Yeah.
Okay.
Let's go with that.
Okay, then the information technology industry, 1.2% short on the float, nothing problem there. And institutional ownership, 94%. We do see PE ratio 30.5 above the industry at 27.5, while price to sales are high, 4.8 versus 1.5. Price to book value of 3.7 versus 4.4. Price to cash flow 15.4 versus 30.2. That's the best thing I've seen yet. No PEG ratio on the company. We do see over the last year, earnings were up 6%, almost double the industry at 3.1. Sales up 6.6%, not as good as the industry at 9.7. Well, this is strange. The 5-year growth rate on the earnings estimate from the analysts, a negative 65.8% versus 1.9% for the industry. So that's disappointing that they think the earnings are going to decline. Would not want to buy a company with declining earnings. Look at the balance sheet. Current ratio 1.1 versus 1.6. That's okay. Debt to equity 1.1, same as the industry. A lot of intangible assets on the balance sheet here, 59.1%. The industry is at 41.4, but intangible assets can be written down and cause you problems. Net profit margin is good, 15.7 versus 7. Return on equity 12.5 versus 20. We do like to see that around 15 at least. And free cash flow, they do have free cash flow about $4.9 billion, about the same as the industry at $5 billion. What do you got, Chase?
Yeah, well, I was kind of curious on this company. The reason I wanted to look at it was, the whole talk of stablecoin. It appears they're trying to broaden their presence in that space, and they actually did sign partnerships with Circle and PayPal to further these efforts. So the shares actually jumped about 18% after that announcement, and I do see they also signed a deal with MasterCard. So, I mean, there's some kind of working material here for that stablecoin space from Fiserv. I was kind of curious too. I mean, they do some other stuff as well. Obviously, they do the payments. They have a company called Clover. I've seen them before. It's not as, I'm going to say, large to me as like Square or anything, but I believe that they're a competitor there. They're in security and fraud protection solutions, stored value solutions, software as a service. So, I mean, they have a bunch of different things. Normally, the summary is very easy to break down for what that business does. This company has a ton of different things going on. So, I don't want to have a little bit deeper of a look at how they make their money and really what are their profit engines at the end of the day. And also, too, sometimes somebody can say, yeah, we're doing a stable coin. And it's like, well, it's 1% of your business. It's not even going to make a difference. So, again, want to have a little bit more detail on what's going on with, again, Fiserv, ticker symbol FI. But looking at the numbers here, the current price is $172.33. I see the 52-week range. I mean, the stock actually has been hit quite hard. The low is $146.46 and the high $238.59. So we have seen a pullback from the highs. Going forward for the company, we go out to December 2026, estimated earnings per share here of $11.90. Gives a target sell of $197.54. So it's trading around 14.5 times future earnings. Not quite at that buy level. It would be a hold based off those valuations.
And actually, the earnings look pretty strong. There's 37 analysts. So the high is 1240, the low is 1109 to get to that 1190. So that's a pretty tight range there. And we do expect some type of pullback coming up here. This could be, if we can learn how to pronounce the name correctly. I was even thinking maybe it's Fiserv. This could be a buy. You said forward PE is 14?
14.5.
14.5.
On a pullback, yeah.
Because generally pullback happens. This would be in the tech side, which I think tech will get hit pretty hard. This could drop down maybe 20, 30, 40%, and all of a sudden, hey, great buy on this company.
I would be curious. I mean, are they kind of in that space of competitors of, PayPal and Square, now Block? I mean, is that who they compete against? I'm not quite sure. I mean, that space has become a little bit more flooded. So I think there is a lot more competition. I'd be a little bit concerned with that. I mean, you talk about a firm and, the kind of buy now, pay later firms. I mean, there's a lot going on within that space. So that would be a concern I would have looking at this business as well.
Yeah, a lot of research to do there before you invest in this company. Possible. All right, stay tuned after the break. We got financial planning with Harrison coming up, talking about what is the net investment income tax. And also we're going to talk about Pinterest, General Mills, and Duke Energy. Stay with us. We'll be back. All righty, welcome back to the second half of the Smart Investing Show. This is where we've got, three companies left to talk about: Pinterest, General Mills, and Duke Energy. But with us is our financial planner, CFP Harrison Johnson, talking about what is net investment income tax. Would you stop finding all these taxes people are paying?
There's a lot of taxes out there, so it makes it complicated. But the net investment income tax, it's a federal tax. It is 3.8% on potential investment income that you have. So it started in 2013. It was a part of the Affordable Care Act, that bill, as a way to pay for it. But it's a 3.8% net investment income tax. It applies if you are a single tax filer and if your income is over $200,000, or if you're married, filing jointly, then it applies if your income is over $250,000. And one thing I wanted to point out is that, again, this was put into play in 2013, but that $200,000 and $250,000 limits, or the thresholds where it starts to apply, those have not been indexed for inflation. So more and more people are being subject to that. Like a lot of things with the tax code, a lot of things are not indexed for inflation. So if your income is above that, then if you have income from interest, dividends, capital gains, rental income, passive business income, annuity income, those are considered investment sources. So to the extent that your income is above those thresholds, those income sources, in addition to being taxed on the federal and the state side, you also have this net investment income tax that kicks on.
And is this on top of, can also include, because you got the Medicare tax too.
Yeah, the Medicare, which is another basically federal tax on your income. So as your income gets higher, federal, state, Medicare, IRMA is what it's called. And then this is the net investment income tax that
3.8%.
3.8% on, whatever your income is above those thresholds.
And I realized too when you're talking, married couples get it in the shorts because you said 200,000 for a single, 250 for a married couple.
Yeah. Yeah.
Well, usually it doubles.
Usually it's double. Yeah. So I don't know why this was that delta is so slim, but yeah, single people up to 200, married, only up to 250 is the room that you can avoid it. So once your income goes above that, you start to trigger it.
It makes it very difficult because our saying is we'll never make a tax decision or economic decision. But gosh, it gets so difficult because you got 3.8%, the Medicare tax, federal tax, state tax. It's really difficult to deal with all these taxes.
I mean, you're talking about, 23.8% on the federal level if you're in that top bracket, plus then your state in California. I mean, if you sell something and have a capital gain, I mean, what does that put you at, over 40% on taxes?
In some cases. And that's the important thing is, you're talking about the capital gain taxes. So that's assuming that it's long-term capital gain or qualified dividends are taxed at that 0, 15, or 20% rate plus the 3.8. But if you have other sources like the rental income, or if you have interest from bonds or things like that, savings account, CDs, that's interest at ordinary income rate. So you could be at, 22, 24, 32, 35, 37% plus this 3.8 plus IRMA plus the state taxes.
Now, how do you, as a financial planner, I mean, and again, I just said that we never make a tax decision over economic decision, but how do you as a financial planner help clients with this?
Well, part of it is understanding that, if you have income that is going to be realized, like a lot of times this comes into play if someone's going to sell a stock, realize a capital gain. Okay, depending on how much you sell, you might also trigger this net investment income tax. Part of the equation is understanding, well, if you don't sell that stock now, how much risk are you carrying by continuing to hold it? And even if you do continue to hold it, is there going to be a way where you could potentially avoid that 3.8% tax in the future? So in other words, if your income is $400,000 and it's always going to be $400,000, well, you're really not ever going to be able to avoid this other than just by never selling anything, which isn't, probably a good strategy. So if there's a way that you can say, well, let's fill up this threshold or fill up the room that you have under that threshold as much as we can, and then maybe we'll put off some of it until next year to avoid it. Sometimes that makes sense. With that, you only are taxed at the rate that your income is above that. So if your income is like $240 and then you have an extra $20,000 of room, so that now you're up to $260, only the amount that's above that $250 would be subject to it. So sometimes, again, you want to do a little bit now, a little bit later. If your income is going to be changing year to year, that depends how much room you have that you want to fill up. But again, you also have the IRMA to worry about, which there's a lot of IRMA brackets and federal brackets and everything. So,
and I'm kind of cheating here. I'm looking at your notes, but
my notes are his notes.
His notes. But this kind of goes back to our conversation earlier about 401ks. I mean, looking at the taxation of capital gains, interest, dividends, all the rental income, as you said, you don't get any of that tax liability if you have Roth or pre-tax contributions, because that avoids, I believe, the 3.8%, correct?
Mm-hmm. Yeah. So, well, any withdrawals that you have from those sources are not considered investment income. So pension income, IRA income, Social Security income, wages, that stuff is not considered investment income. So that's just subject to federal, state, could trigger IRMA, but not this 3.8% tax. However, if you have a situation where you have some investment income and you're under the threshold, but then you withdraw a little bit too much from an IRA, that could increase your income and then push your investment income above that threshold.
Yeah, I just think it really is, again, so important for people to understand the taxation of, capital gains, dividends, interest, because it really, I think, pushes you down the point of why you should be maxing out your 401k, why you should be maxing out your Roth IRA, because it really reduces the concern of taxation that you might have to worry about down the road.
It gives you more flexibility, too, because with an IRA or Roth IRA or whatever it is, you can control how much you're withdrawing. With investment income, if you receive interest, it's taxable. If you receive a dividend, it's taxable. If you own a mutual fund and it distributes capital gain income to you, it's taxable. So when you have more money in retirement accounts, you can choose how much you want to withdraw from which sources, so you can get more control there. And when I'm presenting a plan to somebody, the first thing that I go through with everybody is an overview on how taxes work. How are these different income sources taxed? How can we structure that? What different tax rates are there? Because ultimately, when you're making financial decisions, if you understand how that game is played, then that can show you what types of assets you want to build and then how you can access those in some income sources to create cash flow.
Yeah, and this is one thing that I believe we do it right because Chase and I, we manage a $700 million portfolio. You're the financial planner. And when people come to us, a lot of times you go to somebody, oh, I'm a financial planner, and they do the portfolio. You cannot do both. And you keep proving it week after week that there's so many things you look at because you don't have time to do the investments because there's all these other things you look at as a financial planner that people are not getting by going to your basic CFP financial planner.
Yeah, I just spent 3.5 hours presenting a plan to somebody, and it's not talking about the investing side. It's talking about everything else: taxes, Social Security, retirement, Medicare, debt, all of that stuff. So there's a whole lot that goes into it, as opposed to what's your rate of return of your portfolio.
Well, that's why you're in high demand. Harrison, thank you very much.
All right, thanks, guys.
All right, have a good one. Again, as Harrison Johnson, he is a CFP with Wilsey Asset Management. He is a fee-based planner. There's no annuities or life insurance sold. If you want to have a conversation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or you can send him an email. Go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Free consultation with him to talk about the situation. You will find so many things that are different than probably the guy that you're using because your guy or gal you're using is probably trying to do both investing and financial planning. Can't do both. All right, Chase, what are we going to talk about here first? I think I said Pinterest, right?
Pinterest is next, yes.
Doesn't your wife like that?
She does, yeah. I mean, I think it's a pretty popular app. It's actually funny. We are looking at doing some built-in cabinetry in our back room, and the contractor we're using, they're designing it out and so forth. And she's like, "Send me some of your Pinterest pins, I think they're called,
pins, yeah.
For what you like and stuff." So I mean, I know people use it quite a bit for I think like home vision boards, I'm going to call it, like what you like. Oh, I like that in the backyard, or oh, that's really pretty, and you kind of factor all that in. So I think there's other things she uses it for, like recipes and things like that. I've dabbled around on it just because I was curious what it was, but I'm definitely not a avid Pinterester.
And I'm so upset at myself. I left the notes on my desk about Pinterest, but I know they have, I think it's called ARPU, average revenue unit per
average revenue per user.
Theirs is only like $6.57. Snap is like $12.
Wow.
Other ones, I think Facebook or something else, like $50. I mean, that's one thing that can kind of grow on this company. There's a couple other things that when I read about the company, like, oh, there could be some potential here. Let's go over the numbers for you first. We'll talk more about the company. Maybe Priscilla can go to my office and get the paper thing there. Maybe get the notes from there if you got a second. But PINS is their symbol, PINS, in the Internet Content and Information industry. Float short 4.3, nothing bad there. PE ratio looking pretty good, 13.2 versus 24.7. Price of sales 6.7 versus 6.8. Price to book value 5.2 versus 6. And price to cash flow, unfortunately expensive, 25.9 versus 19. And there is no PEG ratio, unfortunately. Now, the earnings per share growth over the last year is 1,136.4% versus 57. That's got to be some accounting issue. They did not grow their earnings by 1,100%. Sales, however, were up 17.8% versus 3.6 for the industry. Oh, well, something's wrong with the analysts here. 5-year earnings per share growth estimate for the analysts, a negative 218.1. I wonder if the system has some issue here. We'll see like the other companies, but the industry is at 8.4% growth. They do not pay a dividend. Balance sheet. Current ratio, wow, 8.4 versus 2.2. And I'll point out the quick ratio, which is cash and short-term investments, is also 8.4. So that is kind of amazing to me that it is that high. That's a lot of liquidity.
Well, they don't have inventory, so.
Yeah, no inventory. And the debt is, you can come on, Priscilla. Yeah. No, this one right here. Okay. Thank you. Smile for the camera. Yeah, no debt. So very strong financial situation there. We do see the net profit margin. Wow, 50.4% versus 29.7. Return on equity, 40.4 versus 32.3. Free cash flow, not quite as good. $952 million versus $51 billion for the industry. I'm hoping to get some good numbers going forward because this could be a potential good buy. What do you think?
Well, looking at, and gosh, I remember kind of earlier this year, I think you have it from Barron's, but Barron's also, I think, talked about Pinterest earlier, or I saw on CNBC or something, but when it was in the 20s, I remember the numbers looked pretty good on it because the 52-week range is 23.68, high is 44.79, current price though 35.95, so definitely recovered from that low. I did go back though to 2021. It was actually above $80 a share, so we have seen a pretty substantial pullback since then. Going forward though for Pinterest, we go out to, I believe it's December 2026. We see estimated earnings per share here of $2.14. Gives us a target sell, unfortunately, of $35.52. So essentially right at our target multiple of 16.6 times. I would say the stock is fairly valued. I think there is potential upside, as you said, with the business growing, but it just not quite attractive enough from a valuation standpoint.
Yeah, and I see you got 22 analysts there. Yeah, so that is kind of disappointing. What I saw in the notes here was that this was amazing to me. In a survey, hundreds of advertisers, and found that 3/4 of respondents who responded back to this survey of the advertisers with Pinterest said they intend to increase their spending platform by at least 10%. This is up from last year with a half for the fourth quarter. So more of their advertisers saying, we're getting good business from this. We're going to give you 10% more. So that's a positive. So you could see something down the road here with Pinterest. I'm disappointed that the analyst was 22, only gave away $2.14. But
well, and I really think, there's, I think a potential use case where advertising on Pinterest for the right companies, I think makes way more sense than advertising anywhere else. And I say that because, as I said, my wife is using it for this cabinetry right now. Well, what a great opportunity if you're like a home remodeling company, or you're a cabinetry company and you make the wood you advertise on there. So then they're looking at your work without even realizing it, and then it's, I think, a much more kind of dialed in advertising than if you're on Facebook or Instagram, you're just kind of scrolling and an ad pops up. It's like, wow, you actually get somebody that's interested in your product. I can definitely see, I think, the use case for advertising there.
And I did see too that they're using AI quite a bit to target those people, because Pinterest, you can't buy the cabinetry through Pinterest, correct?
I don't believe so.
Yeah. So, but again, if you're looking in that area,
it directs you to their website
for somebody doing cabinetry. And the numbers were on the ARPU was $6.94 in revenue. Facebook, Meta, was $52 and Snap $12. So I think there's a lot of room for growth there. I think this could be one to watch, but it's not a buy, not close to buy, really.
And I want to be careful here, not getting too far into the weeds of this conversation, but I was reading the other day that, in 2018 or something, Meta came out and said up to 40% of their activity that occurs on their platforms could be from AI bots.
Oh.
And my concern with that is, well, if I'm advertising on that platform, right? Why am I advertising if I'm only getting maybe 60% of good leads? I don't think that would be the case on Pinterest, because it's not like a peer-to-peer type thing. You're going there for yourself. So I think that would be another reason for maybe advertisers to shift over to a Pinterest if this is a big problem on Meta, Facebook, Instagram, those platforms there. Again, I don't think you would get that on Pinterest.
Yeah, and we discuss these things, again, to help people understand how we invest and how they should be investing. And it's so important to understand the business that you're talking about. And also, I think it was last week, we did talk about the scams on Facebook, $168 billion. Remember that number I did on KUSI as well. I
really think there could be something brewing for Facebook. Because Meta, because I think there are so many concerns that it's so unregulated. And I get it all the time when we're on the platform and you get all of a sudden, it's like, that's not a real person. That's not a real person. You get it all the time. And it's like, so if that's not a real person and I'm advertising on that platform and that's counted as somebody viewing my ad, and I, again, don't know the back end of it, but I'd assume that's how it works. Isn't that a problem? Like, you're lying essentially of what the numbers are that are being produced. There's some concerns, I would say.
Yeah, I agree with you. All right, well, let's move on. Talk about getting kind of hungry here. Let's talk about a food company, General Mills. Gosh, they've been around for a long time. Maybe you can tell me how long they've been around for. But their symbol, I was surprised, GIS. And I guess GM was taken by General Motors, but GIS is a symbol for General Mills. They are in the packaged food industry, short on the company, 6%, about 87% institutional owned. Good PE ratio of 12.3. However, the industry is only 3.7. Wow, that's very low. I know they're having a lot of trouble with the diet drugs here. Price of sales, 1.5 versus 0.4. Price and book value 3 versus 0.9. Price of cash flow also expensive, 9.7 versus 2.4. And the PEG ratio, nothing great here, 22.6. So I like a PEG ratio around 1 or 2, not 22. As far as the earnings growth goes, 5.6%. Now the industry shows growth of 77.1%, which is extremely high. I'm not sure why. Sales over the last year were down by 1.1% for General Mills, but yet the industry up 368%. 5-year growth rate from the analysts on the earnings, 0.5% for General Mills versus 0.1% for the industry. They do pay a decent dividend, 4.8%, only use 52% of their earnings to pay that out. And we do see on the balance sheet, current ratio a little bit low, 0.7 versus 1.3, and debt a little bit high at 1.5 versus 1.1. Intangible assets also very high, 69%. That's a worrisome sign there for write-downs down the future, perhaps. Net profit margin 13 versus 6.3. Free cash flow pretty good, 2.5 billion, but the industry is at 6.8 billion cash flow.
And I don't know that the intangible assets, the big issue there is all the acquisitions that they have done over time buying the brand. So I'm not surprised to see intangible assets that high. Answer your question, the company was founded in 1866.
Wow. So I guess all that time they've acquired a lot of companies.
They're quite a lot. And I mean, give you some of the names so you can kind of be like, well, General Mills, what do they do? You know, I mean, I'm going to say they're the cereal company. I mean, they have Cheerios, Cinnamon Toast Crunch, Cocoa Puffs, Cookie Crisp, a lot of those good names there. And then they have, some other stuff as well. They actually do have a pets division with Blue Buffalo. They do have, it looks like Fruit by the Foot, Fruit Roll-Up, Lucky Charms, again, another cereal there. Something with Haagen-Dazs. I don't think they own Haagen-Dazs, but maybe they facilitate some of the sales for them or something.
In the grocery store, maybe.
Potentially, yeah. So, I mean, they have, a lot of big, well-known brands. The concern is, the current administration and their push against food dyes.
Oh, yeah.
How is that going to impact General Mills? Because I would personally assume that Gushers and Fruit by the Foot would be large offenders of food dyes. I'm just guessing here.
I think you're guessing probably pretty right.
And I have no idea how this change would impact profit margins, but that is definitely something you would want to understand if you're looking at investing in this company. But looking at the current price here for General Mills to begin, $50.52. 52-week range, the low here, $50.19. They actually did hit that level on Friday, and the high, $75.90. Going forward for the company here, we go out to December. Oh, no, actually, they report on a fiscal basis. So we go out to May 2027. I see estimated earnings per share of $3.86. Gives it a target sell price of $64.08. Forward PE is around 13 times, and it is so interesting. I remember General Mills, their PE used to be in the 20s because, again, it was a defensive name
right.
and, consumer staple. You weren't really worried about that variability to it, but this is, again, one reason we don't like to overpay for companies because things change. And this industry has changed so drastically, I'd say, within the last 3 years. You talked about the diet drugs. We talked about the new administration, kind of them attacking packaged foods. I almost think 13 times earnings for limited growth and the potential concerns for this, I would want to see the valuation fall even further before I would even become interested in a business of this nature.
Well, I have some good news for you because we use two different platforms because we want to check to see if they're different. Mine is different. Mine shows going out to May 2027, $4.20 based on the mean of 11 analysts. So if you do 420, you're probably going to PE a little bit lower. So maybe that would be a little bit better. And the range is not too bad. 397 on the low side, 461. You collect that nice dividend. I just don't know what's going to play out as we talked about with the new administration on the dyes and stuff. And then also, too, GLP-1, whatever. Is it
GLP-1s.
Yeah. That is hurting because you can't eat as much. And I don't think cereal is the big thing it used to be. Do you eat cereal?
No, I don't eat breakfast, actually.
I don't eat breakfast either.
Yeah.
I have a protein drink. That's it.
Yeah. So I guess we're not the market for General Mills, but then who is? And
I don't know.
I do know, again, my wife is, now that we have 2 daughters, is very keen on, diet and food and so forth. And I think she might be a little bit over the top sometimes. Hopefully she didn't hear that. But, she is so against giving our kids any of these cereals because they're just so bad for you, ultimately.
Sugar,
who gives a kid Cookie Crisp and is like, wow, that's a great way to start the day?
And you don't remember this because you're too young, but back in the 90s, a show called Seinfeld with Jerry Seinfeld, he would have cereal in the daytime. Yeah. Those days are gone. I don't think anybody even eats cereal. I don't know. All right, we'll have to do a survey to see what kids are eating cereal.
Who eats cereal now? Yeah. And I was going to say, too, talking about changing times, this stock is definitely not done well. I was looking at the 5-year return. It's actually down here 16% over that 5-year period, 10-year return down 11%. That does not include dividends, so you're still probably up over that time period with dividends, but not exciting returns, to say the least.
Yeah, and it's one that used to be, well, you could always do well on food companies, but I just don't understand what's going to go on with these diet drugs. I still think there's going to be a problem someday down the road. But for now, I just...
We're running out of time here, but I was going to say, I saw that there's some company, their stock went up a bunch because they are a different drug that allows you to offset some of the bone loss or something from the diet. So to fix the drug, they add a new drug. And it's just like, geez, you're going to have to then probably add another drug down there. And I just, as you said, I think there are problems that could occur with these drugs down the road with side effects that people aren't even thinking of just yet.
Actually, in the newsletter we did talk about, and I got to get to the company, but in the newsletter we talk about the second largest exporter or importer of the United States is actually Ireland. I'll kind of give that away. Most of it from the diet drug is going from $15 billion, maybe next year to $30 billion. So they are very popular, but I think there's going to be issues, and maybe that's when you buy the cereals.
Maybe.
Yeah. So let's move on. We don't have much time left, unfortunately. Let's talk about Duke Energy. Their symbol is DUK in the utilities regulated electric energy industry. Not much float on the short side, 1.3%, only 69% institutional owned, and that doesn't surprise me. I think a lot of individuals own a utility. PE ratio 19.4, about the same as the industry at 19. Price of sales 2.9 versus 2. Price to book value 1.8, the same as the industry. Price to cash flow 7.5 versus 7.2, and the PEG ratio 2.3 versus 66. So that is a positive. The earnings per share growth over last year up 7.8% versus 7.4. Sales are up 5% above the industry at 1.7, and a nice, decent 5-year earnings per share growth estimate from the analysts of 8.2% for Duke Energy, which is above the industry at 1.2. They also pay a decent dividend, 3.6%. They use 69% of the earnings to pay that out. They have grown that dividend for 10 years in a row now, actually more than 10 years. Look at the balance sheet. Current ratio, a little bit worrisome. It's 0.8 versus 1. I just would want to keep an eye on their short-term debt and short-term assets here. Debt to equity is a little bit high, 1.7, but the industry is high at 1.6. We do see a net profit margin for Duke Energy of 15.4% versus 11.5. And free cash flow, not good here. It's a negative 189, but the industry is a negative $278 million. What do you got going for it, Chase?
Yeah, I was kind of looking at this company. They were actually founded in 1904, it looks like, in Charlotte, North Carolina. So, they've been around for quite a while. They are electric utilities, and they also do offer gas utilities and infrastructure as well. But it appears that the electric is much larger as it generates, transmits, distributes, and sells electricity to approximately 8.6 million customers in the Southeast and Midwest regions. But the GUNI, which is essentially their gas utilities and infrastructure, only distributes natural gas to approximately 1.7 million customers. So a lot more on the electric side, which I'd say is kind of interesting. They do use coal, hydroelectric, natural gas, oil, renewables, and nuclear fuel as well to actually generate that electricity. So one thing I kind of look at with these utility companies is, are they going to maybe benefit from AI? We're talking a lot about the data centers. That is one thing that I think people need to understand. If you're buying utility, are they in a region where they even be building data centers? And because that is one thing I don't think people realize is a lot of utilities are much more concentrated on certain regions. It's not like they're doing electricity all across the country.
Right.
But looking on the numbers here for Duke Energy, again, their ticker symbol is DUK. It's current price $116.92, 52-week range. The low here $99.21, and the high $125.27. Going forward for Duke Energy, though, disappointed by this. December 2026 estimated earnings per share $6.71, gives a target sell price of $111.39. So I'd really like to find a utility that's on sale. Unfortunately, Duke Energy is not that one.
I'm disappointed because I was hoping the same thing. We do have one utility on our watch list that we are waiting because we do believe, again, there should be a pullback. We do believe that energy going forward is going to be very important because of AI, because of electric vehicles, because of cryptocurrencies. big demand on electricity going forward, and we want to be a part of that, but we just can't get something that's a reasonable price to buy yet. But we're patient. We'll see if we can't find one, but it's not going to be Duke Energy, is it?
Yeah, I was kind of disappointed because Goldman actually did upgrade them to a buy because they said the company's valuation looks attractive, and I'd have to disagree.
I disagree with that as well. All righty. Well, there's the closing bell. Thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as an investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, smartinvesting2000.com, and sign up for the newsletter when you're there. A lot of great information. Thanks for listening. We'll be back next week right here on the Smart Investing Show with Brent and Chase Wilsey.